good afternoon. Before we start, I think Frank and I were talking earlier that this for us is our sort of voyage out into the world again post-COVID, and for us it's the first conference we've had. And I want to thank Bruce and the Greenwich Economic Forum for plowing ahead, having this, bringing us together. I think all of us are feeling pretty energized by being here and seeing old friends again and reconnecting. So thanks to Bruce for his leadership and bringing this group together. And I'm very fortunate to have this conversation with Frank. And why don't we start there, Frank? We've all gone through this phase. You've had a unique perspective on the impact of COVID on talent, on culture, on strategy. What's your perspective as we're emerging in terms of the longer term impact on funds?
Yeah, we mentioned earlier, I think every firm had a disaster recovery site. We're prepared for if New York gets shut down, what do you do? And we were well prepared. We're going to go to Hawthorne. We have so many different sites. And all of a sudden, in a blink of an eye, it was everybody's working from home. And so, that we had to prepare ourselves for that. We had our technology group in late February, early March, effectively go to everyone's home and just make sure that technology worked. I think for us, it was relatively seamless. Having been in business 22 years, partners all knew each other for 15 years. It was a little bit like a steamship, on autopilot for the first go-around, where culture wasn't an issue. We all knew exactly what we had to do. But I'd say the industry in aggregate really did a very good job of managing its way through. I don't think a lot of firms would have been as confident about the outcome as the actual events unfolded.
We heard earlier today some discussion around talent and how difficult and challenging it can be to recruit talent. How about the impact of COVID on your talent that's there, recruiting new talent, and how you manage that going forward?
Yeah, remarkably, we ended up hiring a good number of people during COVID. There are actually a few people in our European office that I've never met in person. I've met them obviously across Zoom, but I'm looking forward to that day. And that's actually the biggest challenge with respect to cultures. Is it's very hard to inculcate people into the culture remotely. And so as we approach, knock wood, the end of this process, looking forward to actually have people in the office. And we're going to go, as I think many firms will, to a hybrid model as a result. Insist on 3 days a week, everybody's in the office, Tuesday, Wednesday, Thursday. Optional the other 2. Potentially a 4th mandated to the extent the manager feels it necessary, with a view towards making sure that we reintegrate everyone at the firm. It's different for different people, right? Across different areas of the firm. I've seen some areas where they absolutely feel that doing it in person makes a big difference, that being in person altogether. And so there are groups that were begging us to be in person as soon as it was an option. Other groups, they organized Zoom calls every day for the entire area, and they found that actually they were more efficient doing it remotely than they had been before. There was an ability to communicate across the entire group in a way that when you were in person, you actually don't do very often. You get together, more in pockets, and others kind of in between. So we've had to be flexible as a relatively small organization we can be, to effectively accommodate both extremes.
So as you're navigating those issues, and we're all going through this, what do you see as the biggest and most important issue facing investors right now?
Well, from an investment standpoint, I think it's the topic that's been the topic of the day. I mean, it's government intervention writ large. Obviously, the focus right now is on the Fed, but you had a tremendous response to COVID, not just on a monetary basis, but on a fiscal as well. I mean, all cards on the table. I'm not the biggest fan of Trump, but what his administration was able to do in terms of the stimulus package was actually quite extraordinary in a very short period of time. Mm-hmm. And I think between that fiscal stimulus and the monetary stimulus that followed, both unprecedented, it both took care of the problem far better than anyone might have predicted. It's also led us to a relatively difficult and uncertain situation right now, and the Fed specifically has their hands full because they obviously don't want to tighten and lead to economic weakness, but it's very hard to argue that $120 billion of monetary stimulus a month, 40 of which is towards mortgages, is appropriate given the strength that we're seeing across the economy and specifically across real estate.
So the Fed's meeting today, what are your expectations of what we might see coming out of this?
Yeah, I mean, I think they've been actually remarkably good at telegraphing the direction that they're heading in, and whether they head towards a taper in November or more likely, I think, a taper December, it's somewhere in that area. I think the obvious question, and Nouriel just addressed it with respect to inflation, is what does inflation look like, not just next year, but the next several years? What we're seeing right now is I think, clearly a lot of temporary factors, but there are also a lot of underlying forces that are pushing inflation higher, and you see it in terms of pricing power for corporations. Mm-hmm. You see it for sure in terms of labor demand. I think the weak labor number that we just saw was much more a problem of supply, not demand. You have anecdotes of wages being increased not just 10, 20%, but in some cases 50%, and not being able to find workers. Those kinds of forces could lead to long-term, more structural inflation issues that are going to be hard to reverse. I don't have the answer. I made the comment to you before we came up here. It's extraordinary to me how many really smart people are on both sides of the inflation argument and feel very strongly about it. I think one of the best bond investors, probably of our generation, Lacey Hunt, would take the absolute opposite view with respect to inflation, that we're more likely to face deflationary forces that are going to be pretty substantial for a long time. I think one of the interesting questions to me is how do you resolve this labor supply-demand imbalance and what's caused it? Because you have a real conundrum in terms of unemployment being roughly 1.5% higher than it was at the lows. It's around 5.2 versus 3.7. You have labor force participation at around, I think, 61.7 versus maybe 63.4 before. So if you look at an entire labor force of 260 million, you're talking about 4.4 million people that have dropped out of the labor force, and 1.5% on 160, another 2.5 that is unemployed. And so why do you have that when demand for labor is so strong? What it seems to me is that it's more individual preferences that have driven it. And to some extent, ironically, the largesse on the part of the government in handing out checks, unemployment insurance, eviction moratorium, and on the part of monetary stimulus, you have wealth, not just at the high end. I think the perception is that QE has really driven wealth much more at the high end than the low end. If you look at consumer balance sheets, the overall consumer balance sheet is better off by, I think, something in the low 20%. If you look at the bottom half of individuals and their balance sheet, the net worth for them has gone up by about 35%, from about $1.9 trillion to about $2.6 trillion. If you look at cash levels overall, you look at checkable deposits and currency, it's about 3.1 trillion compared to 1.1 trillion before, and that's the $2 trillion in excess cash that gets bandied about. But if you look at the bottom 50%, their balance sheet cash had been around 80 billion, and it's now about 225 billion. So people have a lot of excess cash, and I think to some extent it's it's summertime. I'm not going to look for a job quite yet. To some extent, I'm taking care of kids, and now that they're back to school. To some extent, it's unemployment insurance. It just ran out. Eviction moratorium about to be over. It reminds me a little bit of the Rod Stewart line in Maggie May. It's late September, and I think I should be at school. I think workers are, but looking at surveys, workers are exploring that possibility. They're now thinking about going back to work over the next month, 2 months, 3 months. And I think the more optimistic scenario with respect to how this all plays out is that you see non-farm payroll numbers over the course of the next couple of months that reflect the large demand for labor as supply starts to come into the market. And so what that means, by the way, for the Fed is they're in a position where they provided enough liquidity that the demand for labor is there, and excess liquidity is not what we need right now. If anything, it's boosted the balance sheet and allowed people to be a little bit more patient about going back to work.
So the Fed action in the coming year is top of mind for investors. But we also in Washington have a new administration, Democratic Congress. You have lots of other noise coming out of Washington. Gary Gensler is now firmly in the seat and is starting to talk about everything from crypto to short selling to T+1 and equity market structure. How do you think about the broader Washington risks, ex the Fed, on your business and markets?
Yeah, I mean, I should be turning it around to you because you've actually done an extraordinary job at the MFA of pushing back on some of the pressures against the industry. When I think about what are the regulatory impacts on our industry, but they don't really affect us, by the way. I think, and I'll describe them and describe why they don't. But I think there's a push, excuse me, a push towards extending the time frame for carried interest. Obviously, they're talking about $3.5 trillion of stimulus, and they need to find tax revenues to take care of that, and we're an easy target. And even as they talk about 3 years to 5 years, and again, you know the details way better than I do, but they're doing it in a way that really extends the 5 years to longer than that, and also looks to target the transfer of equity interest in the organizations. And the reason I say it doesn't really affect us, we're very few of our revenues are as much as 3 years in terms of, we have some long-term gains, but it's not enough to make a big difference. And we've structured our firm as a permanent vehicle with no permanent equity. Hard to explain, but there's a constant readjustment of the economics that leads to us never going in a direction of either selling a piece of the firm or going public. So it doesn't really impact us, but clearly they're looking to regulate the industry and tax the industry. Disclosures, obviously an issue. The area that really impacts us much more is the direction that they've gone in with respect to antitrust, and to the extent that the conflict with China continues, the Chinese approvals necessary for a lot of the large merger and acquisition transactions. So that part of our business has gotten much more complicated than it was. That's actually a good thing for us, not a bad thing, in that it's a complexity that we've dealt with for 20 years, The more complex, the more dangerous the environment, the larger the spreads, and the better you can do to the extent that you can really analyze what you think the risks are and the direction that they're heading in with respect to antitrust.
Yeah, you're right on a couple of the risks the industry is going to face. Anyone in asset management in the next year is just more disclosure, more reporting. There was an effort in Congress to require managers to report every month their longs, their shorts, their swaps, and potentially credit positions as well on a monthly basis to the SEC, which could be made public. So that gives you an indication of the desire to require more transparency. The other issue that you're going to see a lot of focus on is just climate, and you're seeing this pressure on the banks. It's coming to asset managers, and it's how does this industry engage with climate? And I think that's something everyone's grappling with. Do you have any views on sort of this broader question of climate and the role of investors in that landscape?
Yeah, and I agree with one of the earlier panelists. I think it's going to happen not as much by regulation, but by investor demand. Like the investor side is really going to drive the business in that direction. But before heading there too much, I'd love your thoughts on where we end up on a regulatory basis in the two topics.
You're not allowed to turn this around on me. I was told there would be no questions, Bruce.
Does the Senate approve any version of this, or how does it go?
On the tax bill?
Both with respect to tax revenues and disclosure.
Yeah, I think on the disclosure, I don't think legislation ultimately passes the House. Ultimately passes Congress. I think the House will pass a bill requiring some aggregated short sale disclosure on a quarterly basis, which is already in the Dodd-Frank law. So I don't think that will be too punitive, and I don't think it gets out of Congress. It will get out of the House. It will send a signal to Gensler to move ahead and be aggressive. The area to watch is equity swaps. What happens with security-based swaps? Following Archegos' clear desire by Gensler and the other regulators, including Janet Yellen, to be much more aggressive around swaps. On the climate, I think that's going to be a regulatory play that will take many years. Unlikely Congress will do anything. On tax, if I had to bet, I do think they pass some legislation. I do think that there will be a continued effort to focus on taxes on investment, capital gains, carried interest. There's talk of even taxing derivatives, where there would be a mark-to-market tax on your derivative positions held at year end. So very complicated, but your point, the focus is on the industry, and it is going to continue there.
Gary Gensler, by the way, was a partner of mine at Goldman, and I'm not expressing an opinion on right direction or wrong direction, but he is very smart. He really does his homework, and I can't imagine an outcome where he doesn't focus on kind of the real equity ownership as opposed to allowing it to get.
Right. Well, Frank, thank you for doing this. Bruce,
Delighted.
Again, thank you for the conference, for moving ahead with it and creating this great environment. Appreciate it. Thank you, everyone.
Thank you.